Assalamu alaikum. We at Cornerstone Consulting focus on estate planning and endowments. We have worked with many regional charities and local families and have established vital relationships between donors and nonprofits that emphasize the value of charitable giving in terms of the enormous benefits to the community. In this webinar, we would like to walk you through the steps associated with establishing an endowment fund and pinpoint where and how to proceed in implementing your plan giving program. And in conjunction with our estate planning services, the Cornerstone team can assist you in reaching out to those potential donors who want to make a difference over the long term by donating through their wills and various other estate planning options. Not only is having a plan giving program in place so incredibly important as far as setting the tone for the future of your organization, but it also enables you to start cultivating relationships with those prospective donors who are invested in what you do and the value you bring. Not having such a program or an endowment fund can make the process of receiving donations that are otherwise critical to your work nearly impossible in some circumstances. We are proud to announce that in collaboration with the Shura Council of Southern California, we have embarked upon a plan giving initiative that allows all Muslim families to donate to their Islamic center of choice when creating their estate plan.
So before we begin, let's talk about what is plan giving. Plan giving is a way for donors to leave contributions of their assets to your organization through their wills. At the same time, it can also benefit donors financially in three ways. Lower taxes, trade gifts for income, creates an opportunity for giving when otherwise not possible. A plan gift provides options for everyone. Flexibility can be built into each plan. There are many different kinds to be explored based on a donor's need and preferences. As fundraisers, you know that the simplest approach is to ask for money. Getting the donor to write a check is clean and quick. But when a fundraiser asks for cash donations, they are asking small because they are only asking from the 1% of financial assets held by the donor in cash. Significant wealth is not held in cash. It is held in other financial assets such as real estate, stocks, bonds, and retirement accounts. And these forms are much less accessible by simply writing a check. Without changing this perspective, neither the fundraiser nor the donor will be focused on the possibility of truly transformational gifts that come from non-cash assets.
In this presentation, we will discuss the most common types of planned gifts. We will go through each type individually and explain the benefits. First, a bequest is a gift to charity at a person's death. This is the simplest type of planned gift and one of the easiest to implement. Many people desire to benefit charity but are unable to donate property to charities while they are alive. For example, a donor may have a property that is needed during life to cover living expenses or rising healthcare costs. A donor can retain ownership and use of their property during their lifetime and still benefit the charity by leaving the property to the charity at their death. A donor can leave property to a charity by including a bequest in his or her will or trust, or in the case of property that passes by beneficiary designation, such as individual retirement accounts, by designating the charity as a beneficiary. As you can see, a bequest is simple to understand and easy to implement. The benefits of a bequest include a nice gift to charity. The charity receives cash or property. The donor also benefits by receiving an estate tax deduction. The amount given to charity is not subject to federal estate tax. A bequest preserves lifetime income flexibility. A donor is able to use and control the property while alive.
Another tool is a charitable gift annuity. In case a donor wants to make a gift to charity but needs regular payments to supplement income, the donor and charity can enter into a charitable gift annuity agreement. A charitable gift annuity is a contract between a donor and charity in exchange for a gift of cash or property. A charity agrees to make fixed payments for the life of the donor. A gift annuity contract can start making payments immediately or defer payments for at least 1 year. For a charitable gift annuity, target donors include older donors who desire fixed payments for life and also donors who have cash or appreciated property that produces little or no income. Another planned giving tool is a charitable remainder trust. A charitable remainder trust is a trust where you donate all or a portion of your property to a CRT, retaining lifetime income, avoiding all capital gains taxes, and receiving huge charitable tax deductions. Some of the benefits of a charitable remainder trust include receiving a charitable tax deduction and bypassing gain when the trust sells property tax-free. A CRT can last for the lifetimes of one or more beneficiaries or for a specific term of years and pays a percentage of its value to the trust beneficiary. So how is a CRT implemented? An attorney drafts a charitable remainder trust. Once the CRT is created, the donor transfers cash or appreciated property to the CRT. The CRT is a tax-exempt trust that can sell the appreciated property without paying capital gains tax. The trust then makes regular payments to the donor.
A charitable lead trust is a trust that receives cash or property from the donor, makes payments to charity for a specified period, and at the end of the period distributes the trust property to a specified beneficiary, usually family. Some of the benefits of doing a charitable lead trust include a gift or estate tax deduction, where the donor receives a current federal gift or estate tax deduction for the present value of the payments that will go to charity. When the donor gives property to a lead trust and that property plus growth passes to his or her family with no additional tax. How to implement a CLT. An attorney drafts a charitable lead trust. Once this charitable lead trust is created, the donor transfers cash or property to the CLT. Unlike a CLT is a taxable trust. Every year of the trust term, the CLT will report its income and then take a deduction for the amount that it distributes to charity. Any excess is subject to tax. After the selected term, the asset then passes to the donor.
Life State Reserved. In a life state reserved, a charity accepts a gift of property, either a personal residence or farm, and the donor retains the right to use the property for his or her lifetime. Donors also receive a tax benefit. The donor receives a current federal income tax deduction for the remainder value of the home or farm, and the donor is able to use and control a home or the farm while alive. A donor executes a deed transferring a house or farm to charity. In the deed, the donor retains a life estate, which is the right to live in a home and use it for life. After the donor passes away, the asset then passes to a charity.
Pooled Income Fund. For a pooled income fund, a charity accepts a gift of cash or stock, invests it with similar gifts from other donors, and then distributes a proportionate share of earnings to the donor. At the donor's death, the charity then receives the remainder. The donor receives a current federal income tax deduction. If the property that the donor transfers to the charity appreciates, and this property is sold by the pooled income fund, the donor is able to bypass the capital gains attributed to the asset. Finally, he or she receives a percentage of the pooled income fund earnings every year. Donor transfers cash or appreciated property to the pooled income fund and receives an income tax deduction for the present value of what will be left for the charity at the donor's death. The PIF sells appreciated property and all capital gains is bypassed. The cash or property sale proceeds are invested as part of the PIF. The donor receives a percentage of the PIF earnings each year. These earnings are usually taxed to the donor as all ordinary income. The charity then receives the remainder after the donor passes away.
With a bargain sale, a charity purchases property for less than fair market value or accepts a gift of mortgage property. At this time, the donor gets an income tax deduction for the difference between the fair market value and the sale price of the property. When establishing a bargain sale, there is an immediate benefit to donor. The donor gets a cash payment or debt relief. The donor is also able to avoid capital gain on a gifted part of the property, and he or she receives a current federal income tax deduction for the part of the property given to charity. A bargain sale works just like any other sale, except that the sale price is a bargain, which is less than the property is worth. The donor sells the property to charity and receives a cash payment or debt relief. The donor gets the cash or debt relief he needs, and the charity gets a valuable property for less than full price. The difference between the sale price and the appraised value of the property is a gift to the charity.
Disclosure on attorney and this charity. Thank you for watching this webinar. It is offered by Cornerstone to you as an educational service. While we attempt to provide helpful information about plan giving, this information is not intended as tax, legal, or financial advice. In conclusion, these are some of the plan giving tools available when working with Cornerstone to help your organization receive transformational contributions from your donors. We are proud to announce that in partnership with the Shura Council of Southern California, we have been able to help many nonprofits in terms of setting up endowment funds and initiating their plan giving programs, and we look forward to implementing your plan giving program and reaching out to your potential donors who want to make a difference over the long term by donating through their wills and other estate planning options.